joining us to walk through the fundamentals. We're going to do some trading here in a moment. Srini, good to have you here on an interesting day. We've got a little bit of a drop in the stock after numbers that it seemed like, as we were walking through them yesterday, didn't live up to some of the expectations. What are your first thoughts here?
Absolutely. One of the things I've noticed is that the company has been overachieving on the cloud side. The company has been accelerating its cloud revenue for a number of quarters now. Historically, when the company guided about a year ago that they said that they would do 60% of the revenue from cloud by 2023. But it looks like they've accelerated it, and they'll hit the 2023 mark by 2021, actually this year. So the cloud revenue has been accelerating, and that's caused the headline dip in the number.
Okay, does this tell us, what does it tell us about Splunk? Because it's easy to kind of forgive a company that has done so well in carving out space in data analytics in a really in-demand market. It's easy to kind of look at this and say, okay, hey, they missed one. But at the same time, almost every cloud company I see was in high demand. Their services were pushed forward, their value proposition pushed forward by quarantine and its effects on businesses. How come Splunk didn't get that? How come they didn't get a climb in revenue and better cash flows and customers scrambling for their products?
Actually, the customers are scrambling for the products. You can actually see it in their cloud growth numbers. The cloud revenues grew by 89%, and I don't think there's any platform out there, any other software, SaaS software that's growing at the speed they are growing at the scale that they're growing at. The reason why you don't see on the top line it's because of the revenue recognition. There's something called perpetual versus subscription, and you only recognize 1/3 of the revenue upfront. That's what the mess is. That's what the street's looking at. So that's the issue, really. It's just an accounting. You're recognizing revenue over a period of time, not upfront.
Okay, so walk me through this again, because I mean, from my understanding here, that the cloud business obviously is the growth portion. As you point out, there's big growth there. But is there another business that's weighing on the top line, or is this? How do they have an accounting description that keeps a 98% growth so far back that the top line is negative?
Yes, because what's happening is that just imagine that you have $100 in revenue you're expecting. Okay, if it is coming from perpetual, you recognize all the $100 upfront, right? In a cloud subscription model, what you do is that you only recognize 1/3 of revenue, but the customers have signed in a 3-year contracts. So this revenue is coming. So the best metric to really look at is ARR. So ARR is growing at 89%. That's the metric you should be using. So revenue is not a good metric to use.
I see. Okay. Now, for the other part, because they've got two parts, they do have a more legacy business model as well. We've had Doug Merritt on the show before, and he's walked through some of the AAR stuff. But in the past, it hasn't always been quite as extreme, right? I mean, they've had obviously quite a bit of revenue growth in the past. They've been able to offset some of the declines. Is that right, or has it always been like this? Has it always been so asymmetric?
See, if you look at last 2 years, which bucket the revenue falls into, subscription versus perpetual. Mm-hmm. If more revenue falls into perpetual bucket, you see this big beats. If more revenue actually falls into subscription bucket, you see pullbacks in revenue and declines in revenue. That's the problem. It's essentially, but customers love to buy stuff on subscription basis. And industry analysts and analysts like me will love subscription basis because it gives you visibility. So that's the thing. And there's nothing wrong. This company is executing flawlessly. It's probably one of the best companies in my coverage universe. Interesting.
All right. Now, how do you, though, figure out what the proper valuation is or what the proper price is going to be? I hear you on the annualized recurring revenue, the push into the subscription away from licensing, a big deal. It's what the company has said they want to do, and they're doing it. But in terms of trying to figure out if it's a good investment at the price that it's at after this huge run, how do you figure that out? Because right now on the bottom line, it's not really making it down to the bottom line, right? This is still a stock that on the earnings side has a lot of work to do in terms of getting profitable.
Absolutely. The way we look at some of these companies, there are a lot of companies in tech universe. We have Adobe before. I have company like Varonis in my coverage universe, which are making this transition from perpetual to subscription. So valuing companies such as these is going to be very, very challenging. So the way we look at it is that, are they the best? Does the company have a moat? Is the company best in what they're doing? And I personally look at every company on an EV to sales basis, because EV to sales basis gives you an easy way to compare companies with different models, so to speak. So in my opinion, this company is trading on EV to sales basis about 8.5 times. The peer group is trading at 10 times. And in my opinion, the stock is undervalued. And that's the reason why I keep recommending this stock. And we have a number of customers of ours who are into this big time.
And what is the target price right now? What do you think is a reasonable price for Splunk?
My price target is 250, and I think even 250, it's going to blow past 250 in a couple of quarters.
All right.